Welcome everyone to Let's Get Together, Mergers, Acquisitions, and Benefits Compliance. Thank you all so much for joining us. Our moderator for today's call is Beth Allen. She will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recordings in the Get Wise Wednesday emails and on the NFP website. If there are any portions of this call that you missed, by Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will also be shared in the same email. Additionally, for those who are certified with your PHR, your SPHR, or your GPHR, this webinar is pre-approved for a 1-hour recertification credit. In 24 hours, I will email the program ID for you to record and submit to the HR Certification Institute. This credit will only be available to those who listen to the actual webinar, not those listening to the recording later. Additionally, you must remain on the call for the entirety of the webinar to be eligible for credit. At this time, I'd like to introduce our speakers for today's webinar. Joining us today are Diane Cross, Vice President of Benefits Compliance, and Carol Wood, Vice President of Benefits. We are very excited to have them speaking with us today. It is my pleasure to hand over the call to our speaker. Carol, the floor is yours.
Thank you, and good afternoon, everybody. It's a pleasure to have you with us for our webinar this afternoon on mergers, acquisitions, and benefits compliance. It's a hot topic. We have a lot to share with you, so we'll proceed forward. Do you have my colleague Diane Cross and I are happy to be with you explaining mergers and acquisitions and benefits compliance. Please note, of course, that the following is intended to be used for general guidance purposes only. It's not intended as tax or legal advice. And any questions regarding the application of the law should be addressed to legal or tax counsel. The information we're providing is current as of today. Additional disclaimer here is that our focus here is on health and welfare concepts in mergers and acquisitions. Of course, there are many implications on the retirement side as well. So employers should consult with their counsel, financial advisors, and other vendors with respect to retirement plan concerns. That's not going to be our focus today. Moving forward with our overall agenda, we're going to cover some background and preliminary points, including asset versus stock transactions, which is an important distinction. Cover ERISA and plan design considerations, the ACA employer mandate where applicable, COBRA obligations, cafeteria plan and FSA concerns, non-discrimination testing, and then we'll conclude with some final points and reminders. And I just want to state up front that mergers and acquisitions, they're complex and they're individualized to the parties and the specific companies. So we're just going to cover these topics at a high level. Some of the rules and available guidance is a bit technical and detailed, but please don't get overwhelmed with that. If you leave today with an understanding of, the general concerns and things to be aware of, and the available options and guidance to address those concerns, that's really our goal here. We also do have a white paper. You'll receive a copy of the slides, and we do have a white paper on mergers and acquisitions, benefits compliance that you can request from your broker. Proceeding forward, to give you a little background and some preliminary points. According to some sources, M&A activity has reached record levels. This is really a hot topic. This is due to stock market confidence, low interest rates, private equity investments. These have all encouraged deal making. We also have companies seeking to increase scale and diversify to weather unpredictable times. So there's many reasons for this surge, but of course employee benefits normally does not drive the transaction. And unfortunately benefits are often overlooked until after the closing date. This can result in compliance and employee relations issues and also potential liabilities. preliminary points. If possible, you always want to inquire about the other party's benefit plans as early as possible. Also want to highlight benefits compliance issues requiring review during the due diligence process. It's also very important to understand the structure of the transaction to determine if it's a stock or asset purchase that can really affect how the rules apply, and also to verify the control group status. Is that surviving entity one employer for many purposes? It's also advisable to know the default rules that apply in mergers and acquisitions, for example, the rules applicable to COBRA, and to engage employee benefits counsel. That's super important to have counsel involved who's familiar with the company and the transaction, and also with employee benefits compliance. And then determine each party's benefit plan obligations and incorporate those in the contract, so there isn't a question later on as to who's responsible for a particular aspect of compliance. Let's look at the structure of the transaction, and there's two basic types here. There's a stock purchase and an asset purchase, and Diane and I will be referring back to these throughout the presentation. So looking at the stock purchase first, this is where a buyer purchases the stock or ownership in the seller's business or unit thereof. So as an example, seller owns Company A and Company B. Buyer purchases all the stock of Company A from the seller. Result is that Company A is now owned by buyer and is a member of buyer's control group. With a stock purchase, the employees of the purchased business would continue to be employed by the same legal entity, but ownership of the entity is transferred from seller to buyer. And a merger usually occurs in connection with a stock purchase. And just when we're talking about stock, it doesn't necessarily have to be a company that's issuing stock. We're really talking about an ownership interest. So the main concept here is that the transaction involves a purchase and exchange in ownership, and that the employees that stay on with the company continue in employment with a new owner of that same legal entity. By contrast, with an asset purchase, the buyer is purchasing some or all of the assets of the seller's trade or business and may be assuming certain liabilities. For example, a buyer purchased a manufacturing plant and equipment from the seller. The buyer owns the purchased assets as a result, but has no ownership interest in seller's company. Employees of the purchased entity would normally be considered terminated employees of the seller and may be entitled to COBRA as a result. If these employees are rehired by the buyer, they would be new employees of the buyer. So from the outside, this could look similar to your stock purchase, right? You have these employees with a company continuing in the same desk or same plant, but it's a really very different transaction depending on how it's structured. The other topic that we want to discuss is control group status. And under the IRS rules, there are 3 control group forms. That would be parent subsidiary, the most common, brother, sister, or a combination thereof. And a parent subsidiary control group is where one or more corporations are connected through stock ownership with a common parent. The parent must own 80% of the stock. And again, we're also just referring to ownership of at least one other corporation, and 80% of the stock of each other corporation, except the parent, must be owned by one or more corporation in the group. I think it's probably easier to look at an example. So we have P Corporation that owns 80% of the stock of S Corporation, which owns 80% of the stock of X Corporation. So P is the common parent of a parent subsidiary control group with members P, S, and X. And often it may be 100% ownership, with a parent and subsidiaries, and the parent owns 100%, And this is the most common type of control group. So that's what you'll probably see most often. However, there is another type, the brother-sister, a little more complicated here. This is where a group of corporations in which 5 or fewer common owners directly or indirectly have a controlling interest that's generally 80% or more in the stock of each corporation, and also effective control that generally requires 50% ownership of the stock of each corporation, but only to the extent stock ownership is identical with respect to such corporation. Well, that sounds like a mouthful, so let's look at an example here. We have our shareholders, and our shareholders are individuals or estates or trusts. There would be corporations here, and they have ownership in A Corp and B Corp, and we can see that when we add it all up, they make the 80% threshold, right? They have that controlling interest. The first prong, it's actually 100% ownership. And then we look at effective control. What's the identical ownership in both corporations? And here also, when we add up the identical ownership of each shareholder, we make the 50% threshold. So as a result, A Corp and B Corp are members of the same control group. And please have your tax counsel or accountant making this determination. We're just trying to provide a basic example here. The structures, of course, can be much larger and involve more entities and be complex. So you always want to make sure you refer to a counsel or tax advisor. Why does control group status matter? It matters for many purposes. Generally, members of a control group are considered one employer, under ERISA and the code. So it also matters, right, under the ACA, right, when we're determining a large employer, COBRA, who's a small employer, not subject. So there's many reasons. Employees of different control group members, but also can participate in one group health or welfare plan following the transaction. However, if the arrangement is not a control group, the surviving entity of the transaction is not a control group, then allowing employees of more than one employer to participate in a plan creates a multiple employer welfare arrangement, a MIWA. And MIWAs are subject to additional federal and state law obligations. Amongst these, the Form M1 must be filed with the DOL, initially 30 days after the MIWA creation, and then annually thereafter. And some states require licensure. Some don't even permit new MIWAs for self-insured plans. So there's a lot of additional laws and requirements to be aware of. So that's generally something you're trying to avoid. MIWA concerns also arise, and it can arise in an asset transaction if the seller allows the employees who are hired by the buyer to remain on the seller's group health plan after the transaction. And I would just mention on the last point that there is an exception that allows for a transitional period that may allow that to happen without running afoul of the rules, but that's something to review with your counsel. Then we'll move on just to ERISA and plan design considerations. And we know, of course, ERISA is a broad, sweeping law that covers most group health plans and has significant fiduciary reporting and disclosure obligations. Ideally, ERISA compliance in an M&A begins during the due diligence stage. I realize that doesn't always happen, but ideally, so the buyer can evaluate potential risks associated with the seller's plan. Liabilities could arise from past failures, later unfiled Form 5500. So the buyer particularly would want to review copies of the plan documents, SPDs, past Form 5500 filings. The buyer should also understand the funding of the seller's plan and ensure plan assets are properly handled. If the seller maintained a trust, fidelity, bond, and other requirements attached. Now, typically in the health and welfare context, unlike the retirement context, employers don't maintain a trust. They pay benefits from their general assets. But, if the employer, if the buyer, if the seller did, that's something that you'd have to be aware of and prepare for. You also want to make sure that they're in the transition stage, you're still forwarding contributions timely. The buyer may also want to review the terms of any existing fiduciary liability coverage to determine whether changes will be necessary as a result of the transaction. And it's with a stock transaction where the buyer is taking ownership, where these issues really become a concern. The buyer in a stock transaction, now assuming the buyer has decided to move forward with the transaction, the buyer in a stock transaction will need to decide whether to continue to maintain the seller's plans for the acquired employees. I mean, the seller had a group health plan, and the buyer could retain those plans indefinitely or for a temporary period, maybe just through the end of the plan year. Buyer could also create new plans for the acquired employees. And the other option, which is probably the more common option, is to cover, the buyer could cover the acquired employees under its own existing plans. The buyer may even want to transition employees to their plans as of the closing date. And really, it's the buyer's choice here. Absent specific provisions in the transaction agreement, the buyer generally has discretion to determine how to address the benefits for those newly acquired employees. Let's just look at the plan options here, kind of the pros and cons. If the buyer chooses to maintain the seller's plans, it could ease the transition for acquired employees. They can continue with the coverage that's tailored to their population. But that works against the goals of uniformity in the corporate culture, incorporating those new workers in the buyer's culture. And it also creates additional costs and plan administrative and legal responsibilities because there's multiple Form 5500 filings and documents, SBDs, enrollment, and other communications. So that's something the buyer would need to consider. The buyer would also need to ensure that any contracts with the carriers and service providers are updated according to reflect the new ownership according to those contract terms. And then if we look at the other option, again, probably the more common one, covering the acquired employees under the buyer's plan, this could help to integrate employees into the buyer's organization. It also, inclusion could help to avoid additional costs and administrative burdens of maintaining several plans. The plan document in such case may need to be updated to incorporate that new group. And you'd also have to think really of the disclosures that would need to be provided to the employees, in advance, the SBCs, the materials, so they can make selections from the new plan. Additional considerations, if the transaction occurs in the middle of the plan year, affected employees may experience disruptions in coverage and additional costs. I mean, they may have already, have credits towards their deductible and out-of-pocket limits. So that's something that the buyer might want to consider negotiating, with the seller, negotiating with the insurer to see if it's possible to offer credits. That should be done in advance, of course. The seller would also need to review contracts and notify the carriers and TPA as necessary. And if the seller's plan is going to be terminated as a result, a final Form 5500 would need to be filed, and the obligation on that would probably depend on the timing of when that plan was terminated. And with that, that's just an overview of the plan options, but then there are specific considerations with large plans. And Diane, I'll let you explain those.
Hey, thanks, Carol. So in addition to ERISA and plan design, ACA is a significant consideration when dealing with a business reorganization. So before we get to certain points we want to highlight. Let's do a refresh. As we may know, the ACA employer mandate applies to applicable large employers, as we commonly acronym ALEs. And an employer is an ALE if it employed at least 50 full-time employees on business days during the preceding calendar year. This is an important consideration here, as employees of all members of controlled group are counted for purposes of determining ALE status, which tends to be an issue in the M&A context. So as you may know, to avoid employer mandate penalties, an ALE must extend an offer of coverage, meaning certain requirements, to at least 95% of all full-time employees and their dependent children. Now, if an ALE is a controlled group of related entities with separate EINs, keep in mind that the employer mandate requirements and associated potential penalties will apply on a per employer or per ALE member basis. And then for reporting, each ALE member must report offers of coverage on IRS Forms 1094 and 1095C. So these requirements are kind of the crux of what we're going to talk about over the next few slides that help, identify these considerations when dealing with a business reorganization. So let's first look at what happens when an ALE acquires a non-ALE. So the rules around who is subject, so for step one, making sure with business reorganizations that you understand who's subject to the requirements of the ACA's employer mandate. And the rules around who is subject to it become more complicated when you have a corporate transaction during the year causing an employer to join a group of related employers. Now, we just reviewed the general rules for ALE status are based on employee counts during the preceding calendar year. So you could reason that a transaction that causes a change in the aggregated ALE group membership during the calendar year does not affect or impact whether group members are ALEs for the year in which the transaction occurred. That is a mouthful. But other aspects of the rules create pause. And specifically, the employer mandate has this little point of guidance that says if a person, together with one or more other persons, is treated as a single employer that is an ALE on any day of a calendar month, that person is an applicable large employer for that calendar month. All this to say, this suggests that if a non-ALE is acquired by an ALE during the calendar year, the acquired entity becomes an ALE member beginning with the month in which the acquisition occurs. So that's how we come, that's kind of the muddy waters of how we come to the general view that a non-ALE becomes subject to this employer mandate as of the date of the transaction. Now, absent any further clarification, this could mean treating that non-ALE entity as an ALE member immediately upon closing, and could indeed mean treating it as an ALE member for the entire month in which the transaction occurs. So here there's caution. If the transaction occurs during a month and the entity did not offer affordable minimum value coverage to all of its full-time employees. Now, of course, further guidance would be welcomed on this topic, but these considerations really should be taken into account when determining, let's say, the timing of the closing and affected employees' eligibility for coverage under the buyer's plan. So as you can see in totality here, the cautious approach would be to offer coverage as of the date of the transaction. Let's look at a quick example. We'll take ALE Diane's Donut Shop, 200 full-time employees, acquiring the ownership of a non-ALE Carol's Coffee Company, which has 40 full-time employees, and this occurs on August 31st, 2021. Both entities keep separate EINs and corporate structures. The result here is that Carol's Coffee Company becomes an ALE member subject to the employer mandate as of August 31. That's the transaction closing date. If Carol's Coffee Company fails to offer coverage to at least 95% of its full-time employees in any subsequent month, Carol's Coffee Company could be subject to penalty A under the employer mandate. In taking that a step further, if Carol's Coffee Company offers coverage to those full-time employees, but it's not affordable or of minimum value, the company then could be subject to penalty B. And both Diane's Donut Shop and Carol's Coffee Company would have reporting obligations for 2021. All right, so now let's look at a different situation. Instead of an ALE acquiring a non-ALE, what are the ACA implications when two ALEs merge together? And what if those non-ALEs or a non-ALE acquires another non-ALE and the resulting group has 50 or more full-time employees? Now, looking strictly at the size of the employers during the preceding calendar year, it might again be reasoned that they remain non-ALEs after the transaction. But as we just mentioned, the definition of ALE member in the regulations creates ambiguity here as well. So first and foremost, counsel is best to weigh in given this complex scenario. But let's look at an example. We have Beth's Bicycles of 25 full-time employees with Carol's Cycling Shop, 30 full-time employees in September of 2021. The result here is that, unfortunately, as just mentioned, the guidance isn't clear as to whether the combined entity would be subject to the employer mandate in the first year of the merger. I'll take a step back and explain the general rule or a special rule that states when you have a new ALE form in a year. And that states that whether a new employer is an ALE during its first calendar year is based on the employer's reasonable expectation at that time the business comes into existence. But here it's not clear really how that would apply to the merger and acquisition context. So what do we take away from this aside from a lot of unclarity? Would be the conservative approach is to treat newly formed entity as an ALE, offer coverage prospectively to full-time employees, and satisfy reporting requirements. But I just want to reiterate, though, that as with many M&A aspects, the employer should be consulting with counsel for guidance. All right, so as if that wasn't fun enough, let's switch gears from the acquisition's impact to ALE status, and let's look at impact to determining full-time employee status for the purposes of knowing who needs an offer of coverage to maintain compliance with that employer mandate. So another refresh here, the ACA defines a full-time employee as one who works 30 or more hours per week. And generally speaking, full-time status is measured by the look-back measurement method, which would be counting employees' hours of service that are evaluated during a measurement period to lock in full-time employment for a lock in full-time status or part-time status for the associated stability period. Now, there is another method, the monthly measurement method, and it's a little more straightforward, where the employee's hours of service are evaluated monthly to determine whether that 30 hours per week threshold is met for purposes of an offer of coverage. So why are we talking about this? What happens if one company acquires another company and they have different measurement periods? So for example, one employer might use the monthly method while another uses the look back, or you could have companies where both use the look back, but they have different lengths or start dates in their measurement and stability periods. So as it hopefully is becoming a little clear, consideration has to be given to how employees of the acquired organization will be treated following the transaction if two parties use different measurement methods. Now, there's limited guidance and there's two options to take into consideration here, and this is definitely more muddied waters here. But for purposes of the presentation, we certainly want to give a high-level overview of how to handle or deal with this situation. So option one would be to treat acquired employees like transferred employees. And under this approach, if an acquired employee is in a stability period under the seller at the time of the transaction, then the acquired employee will retain status through the end of his or her stability period. After that, the buyer's measurement and stability periods will apply, taking into account hours of service credited while working for the acquired or the selling organization. Now, if the acquired employee is not in a stability period with respect to the seller's group health plan at the time of the transaction, then the acquired employee's status is determined under the buyer's measurement method, taking into account hours of service credited for the acquired organization, right? So a lot of words there, a lot of concepts. It is hard to digest. I think one takeaway here is it's winning if you walk away from this particular information understanding that there could be some nuances with measurement period and identifying who are full-time employees when you're dealing with an acquisition or another business reorganization. Now, the other option too would be having a transition period. So to continue to apply the seller's measurement method to the acquired employees during a transition period following the transaction date. So again, for purposes of this presentation, this is a high-level overview. As you can see, it's very nuanced, but it's a consideration that employers should be mindful of when they're engaging in business reorganization. So lastly, on the ACA topics, let's review who is responsible for 1094, 1095 reporting. And first, I want to point out that reporting is on the entity and not at the control group level that we've already mentioned. For a stock transaction, there are two possible approaches. The buyer would treat itself as a continuation of the seller and files reporting information on the acquired employees for the entire year under the buyer's EIN. Now, the second option would be for two separate returns are filed for the acquired employees, one under the seller's EIN, the period prior to the transaction closing date, and the second under the buyer's EIN for the period after the closing date. Now let's switch gears here for the asset transaction. Here, remember that there's no ownership transfer. So the seller normally would be responsible for reporting prior to the closing date. And then if the buyer hired any of the former employees, the buyer would report on those employees from the hire date as they would with any newly hired employees. So with that, I'm going to hand it back to Carol to discuss another important topic, COBRA obligations. But before that, Beth, I should ask, are there any questions that we should address before moving on?
There is nothing pressing, so I think y'all are doing a great job. Keep on.
Okay.
Well, thank you, Diane. I know employer mandate's a tough topic, and it's even more complicated in mergers and acquisitions, so thank you. We're going to move forward with COBRA obligations, and I think this is where, by far, we receive the most questions. And unfortunately, it's often after the transaction that people are considering some of these. So let's take a look. I mean, the questions are asked, will the transaction itself create COBRA qualifying events for the seller's employees and dependents? Which party is responsible for providing coverage to the M&A COBRA qualified beneficiaries? And what happens if that responsible party does not maintain the plan that previously covered the employees, like the case with the seller in a spin-off transaction, or doesn't maintain any plan? two small employers, previously exempt, merge together, when does the COBRA obligation begin? And many more questions depending upon the particular transaction. Unfortunately here, we do have rules. This is one area where the IRS has provided COBRA rules to address different situations. And the way it works now, the parties can always go ahead and negotiate, and they often do in the contract, to have the obligations attached differently than the IRS rules would apply. The way it works, though, is that if the parties don't perform as they contracted to do, then the default rules come back into play. So let's just take a look first at some of the commonly asked questions. Does a COBRA qualifying event result from a stock purchase? And remember, with a stock purchase, the employers are continuing employment with the acquired company after the purchase. So there's actually no qualifying event. There's no termination of employment. So keep in mind, for a COBRA qualifying event, you need to have a triggering event that causes the loss of eligibility. So they may have lost eligibility under the seller's plan, but there's really no triggering event, right? There's no termination of employment. As an example, the buyer acquires 100% of the stock of seller, employs all of seller's employees. Employees are previously covered under the seller's group health plan, but the plan was terminated on the closing date. The result is that the acquired employees' and dependents' coverage, they're not entitled to COBRA because there's no qualifying event. And the buyer is generally viewed as the successor employer stepping into the seller's shoes with respect to those employees, the new owner of the business that's continued. It's very likely the buyer will offer coverage to those acquired employees, but even if not, there's typically no COBRA qualifying event. By contrast, does a COBRA qualifying event result from an asset purchase? With an asset purchase, the employees who lose group health plan coverage do generally have a qualifying event. These employees have a termination of employment with the seller, even if they're hired by the buyer. There would be new hires of the buyer. So for an example, let's say a seller has 3 divisions, call them TU and V, provides group health coverage to employees of each division. Seller sells Division V to buyer. It would happen at the end of this month, August 31st, and those V employees are terminated from employment with the seller, and they lose eligibility for the seller's group health coverage on that date. And the buyer hires all of those employees and offers them coverage. Well, the Division V employees and their spouse and dependents, they are COBRA qualified beneficiaries. Right? They have the loss of coverage from the termination of employment, which we know, is a triggering event. The exception here, there's no qualifying events. The buyer is considered a quote-unquote successor employer because the seller stops providing any group health plan coverage in connection with the transaction, and the buyer continues the business operations associated with the assets purchased without interruption or substantial change. The obligation, the analysis of whether the business operations with the assets purchased continue without interruption or substantial change, that's going to be a facts and circumstances determination. So that would be an exception. And these exceptions come into play with COBRA when the seller stops providing any group health coverage. Okay, COBRA responsibilities. Which party is responsible for providing coverage to the M&A COBRA qualified beneficiaries? And the M&A qualified beneficiaries are 2 groups, really. There are those whose COBRA qualifying event occurred prior to the transaction, the COBRA participants are already existing at that time, or those who become beneficiaries as a result in connection with the transaction. Which party is responsible? If the seller maintains any group health plan after the transaction, the seller must provide COBRA coverage to those M&A qualified beneficiaries, and that's really the general rule. If the seller terminates the plan of a sold-off asset, let's say a particular division, the seller must provide coverage under another of its plans. We're looking at this on a control group basis. So, for example, the seller sponsors a group health plan for each of its 3 divisions, TUV, and the seller sells Division T to buyer and terminates the Division T group health plan. The result is that the seller must provide COBRA, right? That's the general rule. It's the seller's obligation to the former Division T employees under either the Division U or Division B group health plan. And that's kind of an odd result if you think about it. I mean, what if they're all insured plans? So now the seller, he's really got to arrange this ahead of time, because these individuals, these COBRA beneficiaries, have a right to coverage to the seller, but it's not on the plan that they were covered on as active participants. If the seller ceases to maintain any group health plan, then the buyer's group health plan must provide the COBRA coverage if the buyer maintains a group health plan, and in the case of an asset purchase, the buyer is a successor employer. So that's the case, the exception, where it can shift back to the buyer if the seller ceases to maintain any group health plan. And again, that's on a control group basis. No member of the seller's control group is maintaining a plan. And then we have a chart that kind of summarizes the rules that we've just gone over, we've just reviewed. Transaction for a stock purchase, we know that's when the buyer is purchasing all of the stock or ownership in the business. The employees continue to be employed by the same legal entity, now owned by that buyer, but the ownership is transferred from seller to buyer. And then with the asset purchase, the buyer is purchasing some or all of the assets. The employees of the purchase entity would normally be terminated employees of the seller, but could be rehired and be new employees of the buyer. The default COBRA rule in both situations, if the seller maintained any group health plan after the transaction, the seller is responsible for offering and maintaining COBRA coverage for any COBRA beneficiaries. If the seller doesn't maintain any group health plan after the transaction, then with the stock purchase, any terminated employees and any present COBRA participants under the seller's plan would be eligible to continue coverage through the buyer's plan. And then with an asset purchase, any terminated or not rehired employees and present COBRA beneficiary under the seller's plan would be eligible to continue coverage through the buyer's COBRA plan, and that's if the buyer is considered a successor employer. That facts and circumstances determination. That's really a good summary, of the general rules. Finally, a merger of small employers. If 2 small employees, each with less than 20 employees, merge together, when does the COBRA obligation begin? The small employer exemption from COBRA applies, of course, to employers who on a control group basis have less than 20 employees on at least 50% of its typical business days in the prior year. With a stock transaction, the employees of both entities in the prior year must be counted for purposes of the exception. So we have Company A merges into Company M on October 1st of this year, and each company had 12 employees in 2020. The surviving Company M is subject to COBRA as of the transaction date, because the combined employee total in 2020 was 24. They're considered, one company now, so you're looking back at both companies' counts in the preceding year. By contrast, with an asset purchase, the parties did not become related entities as a result of the transaction, so the employees in the prior year did not need to be counted together. Buyer purchases a division from the seller on February 1st of this year and hires all of the division's employees, all 10. In 2020, the buyer had 15 employees and the seller had 30 employees, including the 10 in the purchase division. Result here is that the buyer's plan continues to be exempt from COBRA under that small employer exception for the remainder of 2021, but COBRA would apply as of January of next year, of 2022, because the buyer employed 20 or more employees and at least 50% of its typical business days in 2021, right? The merger occurred in February, so, and the threshold was met. That's a summary of the COBRA rules, but there are rules. They're complex, but we do have rules to follow. And with that, I'll turn the presentation back over to Diane to discuss cafeteria plans and options with respect to FSAs.
Okay, Carol. So let's continue our conversation. Another main consideration in business reorganizations would be cafeteria plan rules and specifically health FSAs. So common questions that come up specific to cafeteria plans would be, which plan or plans will survive? How should participants' elections and FSA account balances be handled? How is compliance with non-discrimination rules impacted when the employer's workforce has changed dramatically during the year as a result of the transaction? So let's look at an overview. First, with a stock purchase. When the acquired business has its own cafeteria plan, participants' elections and plan administration could continue without interruption because the employees continue to work for the same employer, and so they're bound by their elections. Now, on the other hand, you could have the goal to implement a more uniform benefits package offering, and the buyer may wish to terminate the acquired business's cafeteria plan upon closing and enroll employees into the buyer's cafeteria plan. Now, in this case, new benefit elections presumably should be permissible. Now, I will say that the regulations don't speak to this scenario, so it is unclear. And another point in this scenario would be that if the cafeteria plan is terminated and it includes a health FSA or a dependent care FSA benefit, employees should certainly be given as much advance notice as possible so they have an opportunity to utilize the existing account balances. So I'm going to stop there and highlight that because we're stressing advanced notice, but as we've messaged through this presentation, unfortunately, oftentimes benefits issues in the M&A process aren't considered until after the transaction. So another home run point to walk away from this too is to think early and often and identify those scenarios that could help smooth benefits administration issues prior to the transaction closing date. Now, switching gears to the asset purchase, with that, employees of the acquired business, their employment is terminated with the seller, and their participation in elections in a cafeteria plan or health FSA benefits maintained by the seller would typically terminate on the transaction date. Now, employees hired by the buyer could be offered participation in the buyer's cafeteria plan, as well as health FSA benefits if that's a benefit offered, and would be given an opportunity to make new elections. If the employees are to participate in an existing plan of the buyer that has a waiting period, often questions are asked, and often an option is for the buyer to waive a waiting period. But as we'll talk about in just a moment, there are certainly non-discrimination issues to keep in mind. But as you can see, there are moving pieces and certainly cafeteria plan issues to address. Now, lastly, under an asset purchase, I will say that in contrast, if the buyer assumes sponsorship of the cafeteria plan covering the employees of the acquired business, which can happen, but it's not as common, elections under the plan in that instance could theoretically continue. All right, so onwards and upwards to health FSA considerations specifically. Now, there is guidance on how to handle health FSA accounts specific to asset purchases. Now, IRS has informally said that this guidance also applies to stock purchases. But let's keep in mind that with a stock purchase, if the acquired business maintains its own cafeteria plan and the plan or own health FSA, and the plan is continued following the transaction, employees' health FSA elections should continue uninterrupted. But this is such a significant question that we receive regarding business reorganizations, is how to handle or eliminate the opportunity of forfeitures under a health FSA or lessen that likelihood. Guidance provides two approaches that would apply if the seller continues its business operations and health FSA after the asset purchase, and if the buyer has or either will create a cafeteria plan that has an health FSA option. So the first option is that the parties could agree to have the transferred employees continue to participate in the seller's FSA plan through the end of the plan year. Employee salary reduction elections would continue, but as if made under the buyer's plan. Now, the second option, which is generally more practical, the buyer could agree to cover the transferred employees under its health FSA for the remainder of the plan year. Now here, the employee account balances, and now keep in mind they could be underspent or overspent, and the seller's health FSA would roll to the buyer's health FSA. And then claims for reimbursement after the asset purchase transaction would be submitted to the buyer's health FSA. And then employee elections would continue for the balance of the plan year under the buyer's plan. Now, keep in mind that the guidance specifically explains that in either of these options, no mid-year election change is permitted. That's also a question we receive a lot. And this is because no eligibility is lost in these scenarios. Instead, those transferred employees remain subject to their existing health FSA elections, which may not be changed for the remainder of the plan year. Now, that's unless another event occurs that would permit an election change under the regulations. But also important to keep in mind, if these options are used, plan amendments are required. Now, because we talk about health FSA specifically, let's take a quick peek at dependent care FSA considerations. Now, that guidance we just mentioned does not expressly or specifically extend to dependent care FSAs, so we would caution that counsel should be consulted for guidance. But we did want to bring up that keep in mind in the event of an asset purchase, the seller could consider adopting a spend down feature, and that would allow those terminated employees to be reimbursed from their dependent care FSA balances incurred during the remainder of the plan year. Now, otherwise, employees would be limited to reimbursement for expenses incurred prior to the termination date. Now, let's keep in mind that COVID-19 temporary relief also allows for spend down on health FSAs too, which is generally unique to dependent care FSAs, but there is temporary guidance that for spend downs can be permitted for health FSAs in 2021 if adopted by the seller's plan. And then quickly, the last main consideration we wanted to talk to today would be those non-discrimination rules. And so let's take a step back, and as you probably realize that the inclusion of newly acquired employees and the structure of those employees' benefits can potentially impact non-discrimination requirements. So how do we see this? Questions come up as to whether the buyer or the merged entity can vary benefits or related costs for different groups of employers. So we have in the italicized text examples of frequent flyer questions. If one entity merges with another and each sponsors a group health plan, can both plans be maintained by the surviving merged entity despite differences in benefits? Or if a buyer purchases an entity in another state, see this very often, can the buyer maintain the acquired company's group health plan separately from its own existing plan, which provides more generous benefits? So the purposes of our webinar today, we're providing a high-level overview on these non-discrimination considerations with M&As, and To be consistent with my terminology, a win here would be to recognize that non-discrimination should be an issue concerned when you are adding a group of employees or changing ownership or there's a variation in benefits. And that logically fits in the M&A context scenario. So keep in mind, the highlights we want to point out is that non-discrimination rules apply on a controlled group basis, and that the employees of acquired businesses must be included in testing, and often post-transaction, as we just went over those common questions, post-transaction can often result in a variance in benefit offerings, whether it's by benefits offered or contributions. As a refresh on very high-level non-discrimination rules, variances in benefits based upon certain bona fide employment-based classifications are permissible, but they can only be varied if similarly situated individuals in a class are treated in the same manner and highly compensated individuals are not favored. If you think and take this one step further, you can see real quickly how when you're acquiring a group of employees, and if you are maintaining different benefits post-transactions or different contributions, where you would really need to consider to make sure that there's not any non-discrimination concerns going on. So with that, I'm going to hand it back over to Carol to do our opposite of intro, so I guess an extra, or to take us home. So Carol, I'll hand it to you.
Thank you, Diane. Yes, I'll conclude our key takeaways. First and foremost, employers should consider benefits administration early on in the process as soon as you become aware of a potential transaction, during due diligence. Counsel should be involved. It's important to know the type of the transaction, whether it's an asset or stock transaction, and the ownership structure. Default rules exist for COBRA and health FSAs, and parties can always negotiate other terms, and those terms should be specified in the transaction agreement. And then it's important always to consider the communication of any benefit plan changes in advance to employees. Those are really the key takeaways, and as I indicated, you'll receive a copy of the slides. We also do have a white paper if you want to have a reference tool should you come across an M&A type situation. And with that, I'll hand this back to you, Amber, to close out the presentation, and I thank everyone for joining us today.
Thank you, Diane and Carol, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sending the recordings in the GetWise email and on the NFP website. If there are any portions of this call that you missed, by Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. Lastly, for those who may have joined our call a little later and who are certified with your PHR, your SPHR, or your GPHR, this webinar is pre-approved for a 1-hour recertification credit. In 24 hours, I will email the program ID number for you to record and submit to the HR Certification Institute. This credit will only be available to those who listen to the actual webinar, not those listening to the recording later. Additionally, you must remain on the call for the entirety of the webinar to be eligible for the credit. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you everyone for joining us, and have a great day.